Hi, in this video I'm going to look at divergences. Now, divergence trading is probably one of the most popular methods with retail traders. It's quite simple to spot. They occur regularly. They can be very good in hindsight in terms of what they've achieved. Quite often people would teach the method a lot because they can pick and choose the hindsight trades. Most of the time they're against trend, and it really depends on how you use them. You can use them with trend, and where you use them with trend they can be a lot more successful. However, the basic principles probably doesn't fit necessarily with all traders, but what do all traders know? When we look at the retail traders and what they're doing, they're often trading completely against the market. At the moment, let's just go to a daily here, and we've got a strong daily trend down on the euro. It's been in this strong trend. It's running southwards at the moment, and if you look at the gauge here of sentiment, and let's just refresh this, around about 71% of traders are long on this market, so they're currently sitting overall on a long position, on average that is 71% long. Okay, you've got some that are massively long. The MyFX book group, they seem to be absolutely long. So there's a lot of traders, and it's used effectively against trend often. It doesn't need to be, but that's where it's often used. Now, I'm sure when people start watching this, there'll be those that really love divergences, whether you're using RSI, MACD, or whatever you're using. They'll really love them, and they won't like this video because it really makes people question things, and I would question things anyway. I've been using RSI divergences for years, and it's a method that I looked at, reviewed, looked at different methods. I had different grades of divergence that I identified, and they still stand the time, but it's about how you use something as opposed to just random. I say randomly, but just using them on every occasion. So firstly, I would suggest when you're looking at divergences, you look at them so that you're trading in the bigger scheme of things in direction with the markets. We'll come back to that. But firstly, I guess there's some people thinking, what's he talking about in terms of a divergence? So let's run over to this market here, and we'll look at the price action coming down. So price is coming down. Now, at any point, you don't know where the bottom is in reality. Now, as a trainer, if I just put my solely took off my trading hat and put my training hat on, I'd say, well, we'll look at the bottom here because we can see what's already happened. I'm going to throw that hat away and just become a trader. We just don't know when it's going to turn. So we'll get divergences running through these markets quite frequently, and often the focus is on the ones that win as opposed to, or trade in the right direction, as to where the trader wants it, or the teacher wants to show you it, as opposed to what really happens. And they so often miss out the other divergences that were there. Now, I'm just going to look at our RSI divergence for a moment, and we'll take this point here, the next low, or the lower low from here. And this is what a divergence is basically. Let me just get a pen to draw on here. It's really dodgy because I'm going to draw badly freehand. So you've got the low between here and over here somewhere. It's gone lower, and the RSI is actually higher at that point. You see it's broadly higher. So, and even the peak between the tops came in higher. So that suggests in terms of the market, this market direction here, as we're looking at it, may be coming to an end. it's suggesting there's actually this is effectively a measure of strength, and well, it's Wilder's relative RSI, relative strength index, and it's the strength of the market. When it's dropping down, it's suggesting a weak market. When it's pushing up to the highs there, it's suggesting a stronger market action. And people use it, and it's used as an overbought, oversold signal. So down here, the market has got relatively oversold according to the signal. It's had its bounce up there. Now, it's not saying it doesn't work. Yeah, sure, we get movements in the shorter time frame. We may have got a bit of divergence coming in from even that little previous high to this one here, but the key thing is that you're looking across the lows here, and you're looking to where the RSI was to that point, to where the RSI was that point. And at this stage here, for some traders, it would be looking for a buy. Now, whatever their method of looking for a buy, people have different sort of theories and wait for up bars and all sorts of things, but that's effectively a divergence. Now, there may be reasons, and the whole thing with indicators, and when I sort of talk about them and suggest, well, they're not that great sometimes, it as I say, it makes people feel quite angry, because of course it's great, I use it all of the time, what does he know? But it's how you use an indicator. So you can make it pretty good, but I'm still looking at, for the majority of traders that retail trading, and looking for the bottoms in the market. Why is 70% retail traders at the moment sitting long on a market that's falling technically, just looking at the price action? The price is king. Why are they looking there at it and wanting to buy it? Why they bought it, not just wanting to buy it, they bought it because they want to catch the bottom. Now, I haven't gone to the absolute bottom. We'll come onto that in a moment. We'll look for an excuse of why they might have bought. But at this stage here, they might not have. There'll be some that will say, well, it didn't do this, that, or the other. And to be fair, if you use Wilder's RSI technique, his divergence technique, you wouldn't be buying at this point here or any of these points here. You would only buy from the two lows that we had there, the lower low here, and you'd only buy if it breaks the high between the two lows. Now, that's a different method to what a lot of people use, and if you use this, it's so much safer, significantly safer. But of course, you're leaving behind a chunk of price action, which again, retail traders don't like doing that. They want to be catching the absolute bottoms. Anyway, you can see I'm a bit skeptical on some of these things, for good reason. I've lost money on it okay, in the past. So what have we got then? We've got next divergence coming in round about here. You had this absolute low running through here. We've had a higher low on the RSI figure there. So there's another divergence that's come in, and it's continued to go. So this first one didn't work, this one didn't work straight away. But as I say, if you're using the trigger method of what Wiles Wider used in terms of the break of the high between the two lows, you'd have been fine. And then it sold off again, and then we started getting divergence between this low here and this low. So that's the third divergence I can see kicking down there. And then again, it's you can't see it so well, but there is a marginal divergence between, well, the price has certainly come down further, and the RSI is a bit flat. It's a lowish grade, but the RSI was actually sitting at this point here at 19.69, and at this point here 20.30. So it was a higher RSI at that point. So there's yet another divergence. And on this occasion, yes, you can see it's moved up, but to a level. And as I said in the first place, it's a good regression type tool. So effectively, you're looking for it to trade back to maybe a bigger trend line level running across to some other point of resistance, a moving average, whatever it may be, a pivot. Then you look at this market, and so we've had how many divergences there where people would have been buying. Certainly they'd be buying at this point, potentially this point, and this point down here. So there's 4 occasions before it actually moved up, and only then did it break the trigger the upside, and then just went horrible. Why? Well, I'll come back to this. Look, the market's in a strong downward trend. Lower highs, lower lows. Yes, it's had this consolidation phase, but it's really, really low. Right, let's get to a bit closer to where things are at the moment. And again, the market's been rolling over. There's been divergence over this low, between this low and this low, so I'm sure that would be drawing people back into it because we're near parity, so they'll be wanting to trade the divergence. And even as I'm recording this, there's a divergence at the lows here, and yet price is still rolling over. So all in all, we're just seeing it continually rolling against these divergences. MACD, a better tool? Well, possibly, only because I should suggest, or should tell you, the RSI setting I have here is particularly aggressive, partly so I can see divergences clearly, but it's on a different setting. It's a much faster setting, a period of only 6, as opposed to the MACD here, which is a bigger period. And it may be that you go with the bigger period and look at it, and you might not be in quite as many or see so many divergences, but there was certainly one around here. It's come off now, but there was certainly one at these between this point and this point before it ran over, and yet it continued straight on there. And you'll see other divergences. Yes, it picked up between the lows here and the lows here, but off it's gone, but not very far. You can pick it up time and time again. It's given divergences. You'll want to see the divergence up here, but there wasn't one. Price didn't push up any higher. It's best bet of price action going was up there. So I've sort of knocked on the head the principle of in terms of divergences and trading them to a degree. And there's another fundamental reason why they don't seem to do quite so well sometimes, is because the market's working impulse waves like so, and within the impulse waves there's often many waves, so the market is always doing wave movements. Now the principle, even if you was trading here, there would be your first divergence most likely. It's just the nature of the calculation. It will give you a divergence nearly on every, nearly, but any decent retracement and a sell-off again, you'll get a divergence because of the nature of the calculation. You don't need to look down here for MACD or RSI or whatever you're using. And there would be another one here, so you'd have 2 divergences sitting there, as I say, by the nature of the calculation. And finally, you might get a wave that goes the opposite way. That's the nature of the markets. They've often in these sort of 5 waves, sometimes they're confusing 5 waves and they've got waves within the waves, but if it's a downward trend you're going to be getting lots of confusion potentially, and same the other way. It doesn't really matter which way you're looking, it's just that the markets are very bearish at the moment, and I've got on my soapbox. So divergences, can we use them? Of course we can use them. I was looking at, for example, and I just looked at here, and I saw, the market was running along pretty choppy. You can't see a divergence. There is no divergence, obviously, on this time frame. However, by coming down the time frames, when you're seeing things and you think, well, actually, I wouldn't mind. I'd like to get into this short. There are easier ways of doing it, but still we can use divergences in that method. Maybe that's the method that gets you into the position, but here I would look at coming down the time frame. So I've just taking that period at the 8th and 18th rather, on the day of the 18th, there was the previous high, the new high, and this is a 5-minute chart. So what we're using here is a 5-minute chart to give us the clues to what's going on in the bigger market. So, and this is suggesting weakness. Now this is weakness. What have we got going for us here? We've got a big time frame coming down. We've got the hourly time frame pretty much chopping, but coming down, and was a bit stalled up to this phase here. It's gone quite spiky and horrible and ugly, and then eventually it's given a sort of a divergence here. There may have been some earlier ones I hadn't looked too well, but they was close to those previous highs over there. There may have been some others that are setting up there. It's a horrible spiky market. Eventually this went, taking the Wilder's approach there, you'd be taking the break just below the 4-hourly pivot there to get into the trade. There was the divergence. So the other people may have taken other or used other methods. I like the short-term time frame to look at. If I want to get into a trade, I'll look for lower highs. So I might have got in a little bit earlier, but either way, this is where you use it. The more important thing is you've got the signal suggesting there's a bit of weakness between the two highs against a strong downward trend market. This is the time where you may find it's much more useful. I just sort of there you go. I just sort of throw that in there because obviously retail traders are great, and however, if you're seeing that they're losing 80%, 80% of retail traders lose with any broker ish. If they're spending a lot of time on this sort of method, well, there's reasoning why. That's not to say any other method would necessarily score massively higher, but you're just putting, by being with trend-based methods or using divergences with trends to get into trades on that event, on that occasion, then you are putting the balance with the market and the direction the market's going, and improve your odds. So I hope you found this useful. Please subscribe if you like my channel, and if you want to be updated when the next video is released. If you've got ideas that you want me to discuss in videos and analyze, I'm happy to do so. Just drop me a note. Okay, take care. Bye for now.